next session, it's actually one that is very exciting. We are going to focus on M&A and partnerships. And we will explore also some of the recent M&A activity in the consumer health space. We are going to start first with Jessica. Jessica is Director of Business Development and Strategy at Norwell Consumer Health. Jessica will dive into partnering in consumer health and also on how to assess differentiation in the space. Jessica, the floor is yours.
Good morning, everybody. Buongiorno. That's about only the Italian I have as well. Thank you for the introduction, Philip. It's a pleasure to kick things off for this part of the session where we're really going to be discussing what makes an OTC asset attractive. And of course, that can mean different things to different people. Right now I'm heading business development for Norwell, but I come from a commercial background, so I hope through my background I can share a little bit maybe of a different perspective. And, I really hope that through this session, if you can remember one or two things and that you can take away and reflect for yourself or the business, that will be mission accomplished for me. So we have about 15 to 20 minutes together. Sorry, I'll just go to the slides. We have about 15 to 20 minutes together. So this is what I propose for the roadmap. So I'll start by sharing a bit of information about Canada and Norwell to set the stage. Norwell is a Canadian company. We're focused on the Canadian market, so I think this background is important. I'll also be discussing what's our portfolio strategy, what's our growth mandate, and then we'll dive into really what we're here to talk about, licensing, partnering, and I want to give it a bit of a perspective on how we can build long-term value when partnering. I'll share some quick thoughts on acquisition. This is part of our growth strategy, but I'll be quick here because my colleagues here will be discussing that more in depth, and I'll finish with some key learnings. So Canada, I'm a proud Canadian. I work for Canadian companies, so I have to share a little bit about Canada. It's a great country. It's also a very attractive market for OTC. So a couple of things you may know about Canada. I'm sure you've heard about Celine Dion. You may have heard about our terrible winters, our hockey fans. But here are a couple of things that you should know when it comes to the OTC market in Canada. One, it's a high-value market. So we're in the top 10 globally, and we'll see some numbers there. There's also a high retail consolidation. So over 70% of the market value in OTC sits within 3 retailers. There's a high penetration of private label. We see it in proportion to other categories into the market. 14% is lower than what you see in other countries, but that's still a pretty important dynamic in our market when launching new products. It's also a highly regulated market. So it's important to have evidence-based and submissions to Health Canada. So for example, here in Canada, we have what we call natural health products. Natural health products fall under the Drug and Food Act. And so they're really a subset of drugs. So when it comes to getting those approved on the Canadian market, it's a lot more regulated for the same product that you could get approved as a dietary supplement in the US. So it's a bit of a different market dynamic. And we're also a self-care friendly market. So in the pharmacy, we have very large section in a pharmacy that are dedicated to self-care, large product assortment, and the pharmacists also play a expanding role within the pharmacy. Some numbers to position Canada in the global OTC market. I have to thank our friends at Euromonitor for sharing those numbers with me. If we exclude the US, India, China, because those are a bit, in a separate class, Canada really is a high value market. So in terms of the revenue, Canada is on the 6th position, and per capita we're 8, with countries ahead that are roughly a smaller population. So despite, our population of 40 million, we still represent a lot of potential for export markets. So who's Norwell? Where do we fit in the Canadian OTC landscape? This is our view, so I don't want to put any company in a box. And this is really focused on the Canadian market as well. Some of those companies are obviously bigger or in a different space when you look at the global market. But Norwell is a Canadian company. Norwell is also a company that is entirely focused on the Canadian market. That's the only market where we play in. And when we benchmark ourselves, we like to say that we're a mid-sized company that plays within the traditional OTC category. So this is really where we focus and we play. So we're here at the bottom. A little bit more about Norwell. So Norwell, I like to say we are a startup with a 40-year history. Our growth journey really began in 2020 when we carved out the business out of pharma science. Pharma science is one of the leading pharmaceutical company in Canada, and so we've decided to carve the business out to give it its own identity, its own focus, with really a mission to grow and drive the OTC business. We've achieved over the last 5 years a CAGR of 12%, and of course we want to continue to grow the business aggressively by doubling its size over the next 5 years. In terms of our portfolio, we have a portfolio of around 20 brands. Our focus is in the digestive, respiratory, and women's health categories. And we have a bit of a hybrid model. So we have brands that we entirely own. We own the brand, we own the formulation, and we have brands that we in-license as well, and some that are in between. I have to say about Norwell, we are primarily brand builders, so we are focused on sales and marketing. We have, I like to say, the luxury of using our affiliate Pharma Science to support us for all the cross-functional operations. So we're well set up for growth, and we're well set up, to scale quickly if we need to. So I'll talk a bit about portfolio strategy. I think it's important to give some context before, we talk about what's important for us when looking at OTC assets. When I think about strategy at its core, for me, strategy, it's about making decisions, making choices around where you're going to focus, where and how you're going to win. And that's not always easy, but we've had, a lot of strategic planning sessions, and for Norwell, this is a little bit of some of the areas where we want to focus our business and where we're looking for OTC assets. So we're focused on our 3 pillars that I just talked about: digestive, respiratory, women's health. This is important. Well, first, I was happy to see that the trend supports, going into those segments, but we also have brands that are really well established in those segments. And from a retail perspective, it helps to have some relevance within certain category to help grow and drive business with the retailers. We're also a consumer pharmacy play first company. We have our own sales force calling on pharmacies, and so we're trying to leverage our strengths. So when we look at product, it needs to be a product that, is on the shelf that customer can self-select. We're focused on growing our own brands. We already have a pretty large portfolio of brands. It's important for us to maintain efficiency within our portfolio, and so as much as possible, we're trying to grow our core brand that we have and build brand equity and leverage that to bring innovation. That brings me to innovation. So we're very innovation driven. We're trying to avoid Me Too product. For a company like us, it's important to come up with products that are differentiated because we sit between the big brands and the big players. and the private label business, and so differentiation and innovation is key for us to drive the business. I'll give one example of how we've played some of this strategy in the Canadian market. If we're thinking about the core OTC categories, for example, I take cough and cold. They're very medicated categories in Canada. There's not a lot of natural health product. This trend is changing, but we were, I'd say one of the first company out there to bring natural health product, clinically proven natural health product into some of the core OTC categories. So that's been a way for us to differentiate and carve out a nice place within those large category in the Canadian market. That's a busy slide, but a little bit about our growth strategy. I mentioned that we have high growth expectation. We want to double the business in the next 5 years, at least, I'm being told. And so our growth is going to come as brand builders, as you can imagine, a lot through investment. So we invest a lot into supporting our own brands. So for example, our core brand through our existing SKU. We invest a lot into supporting new launches. So we have products that we recently launched or that we have in the pipeline. We forecast that 30% of the growth is going to come from those new launches. And then innovation. Innovation is very important. And so under our core brands, we want to launch some new SKU. We want to start to do a little bit of product development, but we're primarily building and innovation through partnership. Partnership has been critical to our growth, and so we've been partnering to bring new products either through our own brands or through other brands. And finally, on the white space, acquisition is an important growth driver of our strategy. And so we're really looking, when we look at acquisition, whether we have the right strategic fit, whether we have the right valuation. But certainly, if we want to hit those numbers, we'll need to close some acquisition to grow. So a couple of my criteria when it comes to licensing. So of course, this is very personal and unique to different companies that have different strategy, and that's why I provided a bit of context on our landscape and where we play, because that's influenced a lot by that. We're talking about what are key considerations for assets, but for me, the deal or the partnership is just as important as the asset when we're looking at new opportunities. On the asset side, it needs to be science-based because of the regulation in the Canadian market. And so we're looking for proven efficacy. We're looking for claims that we can support. We're looking at what are the chances of regulatory approval. We spend quite a lot of time doing some due diligence work on this. It needs to be also a sizable market size. Today, to keep your product on shelf in the pharmacy, it needs to turn, it needs to reach certain levels. If you don't have that, you're out within 12 months. And so sometimes there's nice product opportunity, but we just think it's too niche to keep it on the pharmacy shelf. And it needs to be unique. We need a good story for the consumer, for the customer, for the healthcare professional. We're looking at all stakeholders. On the deal side, or partnership would be a better term, of course the partner is key. We're looking at long-term partnership when building and bringing innovation to the market. And so we're looking for partners that have a good reputation, that are stable, that are trustworthy, that have values and share a vision that is similar to ours. Financial returns, every company has them. Of course, the business case needs to meet some of the thresholds, and we're looking at sales. Margin is very important, and then their payback period and IRR. On the strategic fit, I'll spend a bit more time talking about long-term value, because I think what makes strong partnership is about having that win-win model. And long-term value play a big part into this. Why I'm presenting something on long-term value and how we can build that together, I'd say in our recent discussions, this is probably where we spend the most time working with partners to make sure that we're building and planning for a successful partnership. And I think in terms of the key question, this means different things to different people. You have to think about what long-term success means for your company. For us, for example, at Norwell, it means building brands. So we know and building our own brands. We're not a distributor. And then you need to make sure that your agreement reflects your long-term value. And there's a couple of things that you can look at, right, when planning for long-term value with your partner, like what parties are contributing on the IP front, on the resource front, on the expertise. What are some of the factors, the risk factors that every partner is taking? What are the investments that are being made? And then you need to plan for the what if, right? Because we all want to be in business together forever, but the reality is that things can change, and the way the agreement is structured needs to allow for that as well. So planning for the what if and thinking about what each party will be left with, how transition is handled, and how we ensure continuity. This is very unique to kind of any deal and situation, and it's hard to say there's one way of doing it. In fact, if you look at our portfolio, and I've said, we are primarily brand builders, you'll see brands that we do not own in our portfolio. But we've been able to have discussion with partners early on around what's important and what it represents, and structure it in a way that still meets our requirements in the long term in terms of building value. And so I'm very careful about giving a specific example, because I think it's unique to what's important for your company, and it's also unique to the deal and how you work with the partner. Some quick thoughts on acquisition. Acquisition is definitely a key area for us for growth. I'm not going to talk too much about it. As I said, I think our other colleagues will touch more on this. But at a high level, we're looking for a good strategic fit, and we're looking for the right valuation. We go through extensive due diligence when we do acquisition. I could have pages of what we look for and what we screen. But there's 4 fundamental things that for us at Norwell, we need to answer those questions. 1, product efficacy. We want confidence that the product works. What's the customer experience? What's out there? Is it positive? That's important. Then we have to have confidence that we can grow the business. That's probably the biggest question we have to answer. Why is this asset better in our hands? Gross margin viability. So is there enough gross margin to support the marketing investment required to grow those brands? And finally, brand elasticity. So we're looking for value. So how can we expand this brand? Is there opportunity to bring it in a different category, to make new launches, new channel? So those are some of the big questions we try to answer before when looking at acquisitions. So I'll end with a couple of key learnings. Some of them I've learned the hard way, so I'm a bit newer on the business development side. So I've spent the last 5 years. My background is on the commercial side, but those are some key things that is important when working on a partnership, and that I try to keep in mind when working on such. So first is upfront alignment. I think it's important from the beginning to be clear around what we want to achieve, what are the goals, what are the fundamentals, the expectations. Trust and transparency. I'm personally a pretty open book when it comes to this. I think it helps solve more quickly, advance progress in the negotiation. If you're going to partner with someone, you need to be able to share things as it is and count on each other to build and grow the business. Every opportunity is unique. It's not because it worked before that it will work again. So it's important to take a fresh perspective on how you approach deals. Then I'd say both financials and intangible drivers are important. Sometimes the intangibles are more important. And so you have to trust your instinct here that you have confidence in the opportunity. And then integration and execution. So signing the deal is the first step, but then you need to make sure that there's commitment from both partners and that there's a good collaboration to execute and launch and grow the products. So that was it for me. Thank you very much for your attention. I'll be meeting with a lot of you, but if you have questions or if you want to talk, feel free to come and see me.
Thank you, Jessica. Thank you, Jessica. Perfect transition to the next topic. We will be discussing with Michael and Mathieu the key consideration for evaluating OTC and consumer health assets. It's going to be a discussion, so different format from the previous ones. Michael, you're the Chief Strategy Officer and Corporate Development at Caro. And Mathieu, you lead the value creation team at Charterhouse. Mathieu, Michael, do you want to say a few words before we dive into the content to introduce yourself?
Sure. So good morning, everybody. Nice and excited to be here. So as Philippe kindly said, my name is Mathieu Frison. I'm a partner at Charterhouse. Two quick words about Charterhouse. We're a mid-cap pan-European investor specialized in two sectors, services and healthcare. And within healthcare, I think the whole consumer health OTC space is quite big for us. If you look at the assets that we currently own in our portfolio, you've got Cooper, Consumer Health. It's been mentioned this morning quite a few times. We have Labomar, which is a CDMO, also in an Italian CDMO in the nutraceutical space, and SkinTech, more on the dermoaesthetics space out of Spain. So feel free to reach out, by the way, if you're an owner or CEO of a business and want to have a discussion after this talk.
Hey, I'm Michael. I worked large corporate M&A for the last 16.5 years for Bayer. Joined Caro 3 years ago. Caro was owned by EQT, now recently owned by KKR, basically private equity platform like Cooper. Primarily Nordics, now ventured into pan-Europe and now in more than 90 countries. Nice to meet you.
Exciting discussion in front of us. Two very complementary profiles, so it's what I like about the discussion. So maybe if we start by setting a bit the context, a lot of M&A in the market in the past 12 to 18 months. Could you share your views and observations on what's happening on the market on the M&A front?
Yeah, so first of all, I think the M&A market in consumer health, OTC, has completely changed, also on established RX. I would say primarily this was a US topic. We didn't see a lot of deals in Europe over the last years. Heavy deal momentum in the US, and this has completely flipped to the opposite. Now the US, for many reasons, we have seen IQVIA data, that the US is struggling on growth, and therefore, in particular on VMS, you see less and less transactions. and I would say it started with Caro coming out in April, that we are seeing now a heavy deal environment. We've seen Stada, Zentiva. We also see new players. I would say the large guys have been muted. The buyers, the Kenvues, the Haleons haven't done deals over the last couple of years. Everybody is working a little bit on their own topic right now. While we have the new guys coming in, GTCR from the US, a private equity fund, where we have new kids on the block with Capvest at Stada, and we also have new investors. Sidus just bought a business in the UK. Dr. Reddy's bought Nicotinell from Haleon. So therefore, we have a completely changed deal environment, which I think we are all benefiting from. I'm very, very happy to see that these transactions have gone through, to see Stada trading. I think this helps all of us at fairly attractive multiples that this is going to continue.
Maybe just a couple words on top of this, at least in our view. I see a difference between lower caps, so smaller businesses, mid to large businesses. I think what Michael just mentioned, I think, is very true for mid to larger businesses. On the smaller side of things, we've seen a continued activity for the past years. I mean, the market, as you guys know, is still very fragmented, and there's quite a lot of consolidation going on in the market. And of course, the picking up, I think it's fairly easy to understand. I mean, the two reasons is, first of all, there's a lot of dry powder on the market, on the private capital part of things, and that's why you see the big Opelas and mega deals taking place. And then on the other side, the Zentivas, etc., you're alluding to is more of the need of returning capital to investors, and of course healthcare and more specifically consumer health assets are still an attractive pocket where you can I think generate and deliver quite a lot of value. That's why investors prioritize those assets in the exit space right now.
We mentioned dry powder. We mentioned a lot of M&A activity in the space. Generally, this leads to increase in terms of valuation and multiples. Could you share your views on the evolution of this topic and also how you adjust in the context of increase in terms of valuation in the category?
Yeah, it's one of my favorite topics because since years I'm talking to some bankers to whom I'm close that they are telling me multiples are coming down in the space, which simply hasn't happened at all. We have been participating recently in auctions where I have clearly the opposite experience. So therefore, we see partially, or in OTC for sure, crazy multiples, which are going up and up. We see many transactions now over 5 times net sales, which wasn't the case at Bayer when we were in 2010 plus. So therefore, overall, transactions have increased when they really happen. The challenge is you have many stalled auctions, many assets are not even trading. I would say there's a trend right now in VMS that most assets are not even trading. It's rarely the case that you see things ultimately coming to a deal. OTC, I would say you have a fairly high transaction likelihood. We will not adjust the way we are looking at assets or the way we are evaluating companies. And at a certain point, we simply will walk away. I think in the end, it's about synergy realization and can we be a different partner? I like the presentation from Norwell. It's the same way we look at deals. That's also the challenge that we always have to think about. Why would we be a better home for an asset versus competition, and then rather not participate in an auction? But my learning coming from large corporate at Bayer to a PE platform is that we much more look at immediate synergy realization and immediate VCP value creation instead of longer term net present value valuations.
Yeah, so I think just maybe to add a couple points, seeing the same thing. I think the reason why valuation hasn't really come down is because, as we mentioned before, at least on the larger deals, volume has come a bit down, and so the deals that you see hitting the market are high quality assets. And so, of course, if you have growth, if you have margin, if you have cash conversion, you can still see those high multiples down there. What's happening at the same time is you can see also a longer holding period on assets, at least on the private equity side of things, and that's because there's a bit of an aversion to trying to bring deals to the market because probably valuations will be lower, and so in order for you to return capital, you need to hold your asset a bit longer. So I wouldn't be surprised if for not such high quality assets you would see valuation going down.
Perfect transition, Mathieu, to the next question, which is around how to define a quality asset in the space, and I'm keen to have both of your point of view on this, because I'm sure at the end of the day it's going to be about having a very differentiated value proposition, but I'm sure you have different ways also of looking at that. So keen to have your view on how to define a quality asset in the space.
Yes, so maybe, and again, I think there's probably different answers. So once again, on the private equity side, maybe a bit different for trades and corporates. So in private equity, we value the value creation potential on an asset. We value cash conversion, and of course exit optionality. That's very important. So when we look at a business, we obviously look at the brand equity of that business. We look at the go-to-market that this business has, just to try to see if the growth that asset has delivered over the past years is sustainable, if you can expand. So anything that touches on your top line levers. Of course, EBITDA margin is quite important, so making sure that this is resilient, that you have pricing power on your product, so that you can pass through in the events of high inflation. And then, of course, I think something we might have touched maybe early on in the morning, having clarity on regulatory affairs. So, for example, in the medical devices space, everybody is aware we've been through the MDR, which, there's a before and an after, and the clear winners post-MDR have now, I think, a stronger position in the market. So these would be the things, amongst other things that we would be looking at.
I really liked what Jessica said from Norbel, the way Norbel is looking at quality assets, which very much resonates the way we look at things. On top, I would say for us the conversation with the HCP on KOL is very important. I think we have to be honest to ourselves, where can we create differentiated value? And then we believe that having a halo coming out of the HCP KOL makes a difference for us. So therefore, you can either go through mainstream marketing, or you try to build a sales force and try to differentiate ourselves, which is based on differentiated science. So in the end, it always comes down to the science. Is there efficacy? So therefore, I'm only repeating what Jessica already said. For us, there needs to be a large pool of value creation, primarily on the COGS side. So we usually do tech transfers, which means there needs to be enough juice on the COGS side to create more space for A&P investments and drive the brand. We also see ourselves as brand builders. So therefore, if we don't see like 10 to 15% A&P space, we operate at 30% EBITDA margin. So the math simply brings you to high gross margin brands. And as a red flag, I've learned my lessons over the last 15 years that we stay away from shiny toys, where, Jessica talked about Me Too. I also struggle if there are low entry barriers into the space, if there is not a lot of differentiation, then I struggle to see how we can create more value out of an asset versus competition.
Yeah, maybe one additional red flag or area of diligence is always the supply chain. So try to look out for opaque supply chain or specific manufacturer dependencies, because these could also bring some bad surprises sometimes.
Thank you both. Based on your experience, what would be the advice you would give to a company, a management team preparing for an acquisition or a strategic collaboration with a group?
Yeah, what we have learned from our exit to KKR recently is that the amount of diligence is significantly higher than ever before. I think this is now absolutely normal that people want to see if you are selling kind of an M&A track record as a platform. They want to see at least 5 years plus of proof points that you have delivered on your M&A strategy, how you have created value. Value creation programs are now must-haves. This not a nice to have. You have to demonstrate that you were able to create value out of certain value levers. So therefore, what I can only recommend is that you are over-prepared. In our exit with EQT, we had probably the platinum. EQT likes platinum exits, which means all fact books you can imagine, including a tech fact book. Extensive preparation, which was always a little bit on the table, but I think this has come to the next level. People want to understand volume price in detail over at least 5 years, and therefore preparation is more important than ever before.
So maybe just reinforcing, I think I completely agree, by the way. But maybe on Michael's first point is have clean financials as detailed as possible to be able to go a bit deeper, granular in the due diligence. That's quite important. So preparing for that, especially for smaller or more medium-sized businesses, having a very clear growth story. So it's important to separate what is proven and what you've done and what you're convinced that you can do from what is aspirational. Obviously, hopefully, investors, whether it's a fund or a corporate, are not stupid. They're in this market, so just make sure that you're speaking clearly there. Be transparent. Be transparent on risks. Be transparent on, again, where you're very highly confident and where there's a bit more aspiration. And most importantly for us, especially at Charterhouse, we do partnership deals with management and with owners of businesses with whom we reinvest. That's let's say our trademark. We don't really do auction processes, and therefore aligning with management is very important. So prior the sale of an asset, I think it's very important to make sure what management or what the ownership wants to do. Are they do they want to tag along and go on for the next value creation journey, or do they want to exit? You will have very different equations if it's answer A or B to that question.
Yeah, reflecting of what you just said, Mathieu. I think what also has changed, it's much more a continuous dialogue. I don't think you are now waiting for exit windows because nobody really knows is the exit in 5 years. I think you are rather more permanently staying transactionable, which means you keep a financial cube alive all the time, that very, very quickly you can switch gears and go into a transaction. You are permanently in exchange with potential investors. Along the way, you are delivering them proof points that this is not only a story, but there is organic growth happening year by year. So I think it's much more a continuous conversation than it has ever been, than an event-driven situation.
Cannot agree more. We actually do a lot of due diligence for private equity or for corporate, and definitely we go deeper than a few years ago in the way we diligence a company. And as you just said, Michael, I think the point around having a story ready all the time is very important, because you cannot come to a process and try to shape a story because you are talking to an investor. You need to be ready. You need to have your long-term vision also clearly defined and the path to go there. And it's a good transition to the next topic, and it's also one you mentioned several times. In a market environment with higher multiples, where it's let's say more expensive to acquire assets and everything, value creation is now more important than ever. So I'm keen to have both of your views on what actually makes, what are let's say the best practices in terms of designing, but also executing a value creation plan in the space.
Yeah, so I think what's key, at least for us, is to be pragmatic, right? So because designing and having a nice pack of slides or an Excel spreadsheet is very easy, but executing is a different story. So what is key, in my opinion, is to prioritize. It's very easy to identify all the value creation levers, you know, on top line, on your bottom line, on the cash. They will always be the same. What is key is to really prioritize what are the 2-3 key levers that you want to pull, and make sure that you really go into the details for these levers, creating actionable plans. Second point is mobilizing the organization, mobilizing obviously top management, but also a few levels below. That's the difference. They are the ones delivering the value creation plan, and you know, obviously as investors, we rely highly on management, and that's why actually I think a good chunk of our time is spent into you know, strengthening management and investing in human capital. And the last point obviously is you need to make sure that you have a very solid monitoring and tracking of your value creation plan, which is not you know, your sales or your EBITDA or your costs. It's all the actions that are below that build your plan, right? So whether it's on new product development, on pricing, on go-to-market sales force, or on manufacturing, you really need to go detailed and make sure that you track this monthly at the board level.
Yeah, I'm still surprised that corporates in my old life are not fully leveraging value creation plans in their day-to-day lives. So it's still, and maybe I'm off, but for me it's still kind of a PE environment thing. I think there's a lot of value on the table for corporates as well to spend much more time on VCPs. Let's not underestimate, this is a huge amount of work for a management team. This absorbs at least 1 day per week for every ExCo member. So therefore, a lot of passion goes into everyday execution. In the end, it can only be delivered if the CEO is fully behind it. If you don't have the CEO fully being on board and then trickling this down into the full organization and having it as a topic and theme in town halls, then you will not deliver on the value. So therefore, the connection is extremely important to the financials, that you are able to break down initiatives into specific financial targets, that you are able to monitor it in a dashboard on a weekly basis or a monthly basis. Otherwise, it becomes an artificial conversation. And we've been also in a situation when I joined Caro, starting our first VCP, and I don't think we did a really good job in executing it. I think we harvested some of the value, but there's still a lot on the table. So therefore, I think in the end, it's about a full organizational commitment, like you said, Mathieu. Otherwise, you're not delivering on it. And you need the team in the VCP transformational office needs to be your A team. So that otherwise it simply doesn't work. And you have to be fairly frustration resistant because every morning you have to get up and climb up the mountain again.
I think the reaction I have to that and to the dynamic you're describing is you also need to be prepared to react, right? Because I think most of the time things don't go as planned, and so you need to be able to pivot, adapt to a changing situation. I think the new norm nowadays is disruption, is change. We've seen it, on the geopolitical front, on the supply chain front. I mean, we've gone, if you look at the past 5 years, from crisis to crisis, right? So that's a new normal. You need to be able to adapt pretty quickly to the environment.
Maybe one comment and one additional question on this topic. So first comment, I definitely share your view on VCP, so value creation plan being, let's say, very common in what we call portco companies, so companies that are owned by private equity, but a bit less within corporate. It's definitely something we we see sometimes you need a bit of support from let's say an external advisor also to put that in place. So we happen to do that. I'm just saying. And then one question, one very important point you mentioned, Mathieu and also Michael, is the prioritization. I think. As you just said, it's really easy to come up with a very long list, a wish list of things to do, but the prioritization is key. How do you prioritize? How do you prioritize these initiatives to make sure that you both grab the, let's say, low-hanging fruits, but also you invest on the long-term value creation levers?
Quick thought there is well, I would look at three things, right? Obviously, it's the value creation, so your EBITDA or cash generation out of that initiative, the how easy or how capable our team is of delivering that initiative would be the second criteria, and then there's a third one, which is sometimes overseen, but quite important, which is a bit more strategic. In the previous question, I said that we look a lot at exit optionality when we buy an asset. We buy the asset for now, but we see how sellable that asset is tomorrow. And sometimes you're trying to go through strategic shifts. So just to give an easy example, at Cooper, we acquired Cooper. It was 50 million EBITDA, a French-only leader. And really the vision was to convert that into a pan-European leader, which is today. Today it's, I think, a decent pan-European player with around 300 million EBITDA. And so everything that we do needs to go into that direction. So we wanted to internationalize. And there's several ways of doing that. Obviously, you can do it through M&A, but you can do it organically as well. So sometimes it doesn't rank very high on EBITDA generation, but it opens a new country, or it opens the door in a new subcategory through innovation of a market which is relevant for your story. And this is something that should be taken into account.
Yeah, I'm very glad that you're saying this, because I think this most of the time really missed out. On the one hand, having value creation programs on saving costs is not a very difficult exercise. The problem for our industry is we are not generating volume growth. So everything in my world needs to be focused on volume growth. How do can we be able to drive volume? And then it pays into the 5-year exit horizon. What is our long-term equity story? You are not cost-cutting yourself into glory. In the end, you have to show superior volume growth to market, and generally superior market growth. So therefore, these are the levers I'm always the most focused on, because they are the most difficult to generate.
Maybe looking forward, next 3 to 5 years, what are the segments or sub-segments that you see as the most attractive for M&A activity in the space?
So I think in OTC or consumer health, so we've seen a lot of slides today on the market growth. There's been a question on volume versus value growth, and we've seen this per country. We don't really look at the OTC market. I don't think there's such a thing as the OTC market. What really counts is the sub-markets, right? So your vitamin and minerals has nothing to do with cough and cold or with calm and sleeping. And so we really need to go to that level of categories per segment and per country. I think there's plenty of growth opportunity in each of these markets. I mean, I've made an allusion maybe a bit more on the technological application side of things, but I think the medical devices space post MDR has changed, and so you've got some players which now have higher barriers of entry, which are better differentiated than before. Obviously, I'm a bit biased, but since we just invested in Labomar a couple of years ago, we love nutraceuticals. I think Thomas mentioned probiotics. Yeah, it's a big thing. Penetration probiotics still super low. There's a massive trend of growth there. dermocosmetics as well. You know, the whole hyaluronic acid trend. All these are categories that are growing 20% plus CAGR. But so all that is on the brand side of things. But you know, I think manufacturing with IP is also a very, very relevant and interesting market as well for us.
I think good news for our industry is that we are right now in disruptive times. I was last week in New York participating at a conference. 1 in 8 people in the US is on a GLP-1 right now in the US. We are talking about a disruptive change in our healthcare system. This will have a huge impact. I think obesity rates are first time in the US now coming down. So GLP-1, huge topic. Microbiome on skin and gut, huge topic. So first and personalized medicine and personalized products. So I think together with tech, I think we have a chance over the next 5 to 10 years to see disruptive growth. And we are already there. I think in the US I saw products like sugar to fiber. This will disrupt the market and will disrupt health. Longevity is for me a much bigger theme, that people ultimately not naturally live longer, but simply live a better life until the end of their lifespan. So therefore, I think these disruptive changes we've also seen in one of the prior presentations is around the corner, and this will generate growth for the whole industry over the next 5-10 years.
Maybe last question. You don't need to name it, but I would be keen to hear about one example of a deal you walk away from or you lost recently, and what you learned from this experience.
So I think, you know, at least in our market, it's a daily thing. Walking away, it's a decision. I think there's no right or wrong answer. It depends on what you are looking for. Obviously, echoing what I've mentioned a bit before, what we, for example, don't like is when there's a bit too much window dressing on your EBITDA. As you know, we discussed, there's a decent amount of due diligence going on, and so when you uncover and peel the onion and start seeing that EBITDA is much lower, never shows and never translates into trust. I think when an asset has no specific competitive edge, whether it's the products it has, whether it's its go-to-market, whether it's cost structure, are the key aspects. If you're a winner or a leader in your category, how small that category is, I think that will always translate into a positive transaction for whoever it is. And going back to what I just said, be transparent with whoever the acquirer is, and make sure that you're aligned with what this acquirer is looking forward to do. I think these are the important points.
I think one of my learnings is judging an M&A deal in hindsight is always easy. Going back to after what was ultimately the purchase price, ultimately the competition in the final round, and then realizing that you have done something wrong or right is always easy. We have lost many auctions, primarily when we come to a certain valuation bracket, which doesn't work for us, then we walk away. I just struggle if we in the board don't have the full alignment on the runway on a brand. If you see there's a strong brand equity, and you can always discuss about the business case, but if the vision isn't there where this asset can travel, and then you try to be smarter than anybody else, and try to get an asset cheap, usually it never works. I strongly believe getting assets cheap is an idea that you are smarter than the owners is fairly naive. And I've rarely seen this working out, by the way, that you are outsmarting other people.
Thanks a lot, both for the discussion. Do you have any questions before we close? I think we have maybe 2 minutes. Two questions.
Thank you both for the interesting discussion. You mentioned your priorities with regard to the categories where you see growth potential, and I couldn't agree more with your assessment. How do you see the different sales channels evolving? So traditionally, OTC industry was very much linked to brick and mortar pharmacies. I have presented online pharmacies as an emerging channel, but there are others. We have seen Amazon on stage, and we see also more activity in direct-to-consumer shops selling these types of products. How do you see that evolving going forward?
So I think that the answer is different per geography, and specifically, I think Jessica was mentioning Canada, concentrated into 3 retailers. You've got the same situation in the Netherlands with a couple of retailers, and the same in the UK with a couple of retailers, versus Italy, France, Spain, which are, each of them around 20,000 independent pharmacies. So very different markets. So the answer will be different per market in that respect. Then on the additional channels online, I think this has been one of the boosters of market growth. I don't see, there probably is a bit of cannibalization, but this is, additional. It brings you new consumers, and it's an additional opportunity for volume growth. As Michael was pointing, we've experienced this at Cooper directly. So when we first acquired Cooper, there was 0 online sales. We invested, as I mentioned before, hired an entire team for the whole digital sales plan. And today's online sales is 10% of the group, and it hasn't cannibalized the rest of the, when executed, obviously, when executed correctly and making sure that you don't go against your brick and mortar customers, it can be incremental. So I see it more as an opportunity, but you need to make sure, once again, that you are ready to execute, pivot, and seize those new market opportunities.
I think 100% agree. I think the channel question is one of the key questions given our fragmented markets in Europe, and the difference is obvious in each country. And many companies, in particular the large corporates, I think are still struggling with going omni-channel or multi-channel, however you want to call it. The consumer is everywhere. I think we see more and more even pharmacies realizing there can be also an interesting halo. It's not always cannibalization. There can even be in halo, we see this in Denmark and other Nordic markets, that if a retail channel is growing, this can still mean the brand grows in pharmacy. So I think that the pharmacies were always negative. If a brand is multi-channel, is negative. This is a little bit of an old myth, which is being killed as we speak. That e-com is part of every channel is clear, and certainly going to grow. Probably it will also come to a flattening out at a certain point in time. But the future will be multi-channel. There is no limitation. You have to be where the consumer is, and that's basically it.
Thank you both. I think we had one question in the back also.
Yeah, the mic works. Thank you, I'm here. So one question to the gentleman. Do you think that investors and funds from outside of Europe would be short and midterm interested in acquiring nutraceutical assets from Europe, thus making your work also a little bit more difficult, inflating the prices, or Europe as a whole is not attractive enough for these other regions, and they take their money elsewhere?
I'm gonna share my personal opinion. Obviously, I can't speak for for other funds, but what is happening, and I'm talking here a level up. So private equity funds. So funds are invested by limited partners, and what is happening right now is that you see a massive rush of American, US based limited partners investing into European funds. That's for sure is happening. So there is an interest in diversifying and going from Europe, who is, I think, rejuvenated and as a new El Dorado in our little world. And so for sure, there might be US funds interested in acquiring a European platform, but that will depend very much on that fund strategy. What we have seen for the past 10 years still is for specialized funds, the geography doesn't matter too much. So if you have consumer health or OTC specialized funds, and there are some, and it's a US based, they will have absolutely no issues in investing. And we've seen some on a couple of potential deals we've come across with US investors, so they are there. So I wouldn't be surprised if this is more and more common. But
Okay.
again, it's my opinion.
Thank you. What about Eastern funds? Middle East, Southeast Asia.
Yeah.
Are they interested in European assets or not so much?
So Middle East, again, I'm just disclaimer, this is my opinion, but what happens with Middle East is very concentrated and very large amounts of money we're talking about. And so there's a massive interest, but it's more for, larger deals. So, tomorrow I wouldn't be surprised if, at least as a co-investor, a Middle Eastern investor would acquire or enter, into the capital of a Cooper, of a Cairo, Opella, and all these, because they're looking for large tickets, 500 million plus, I would say. So definitely an interest, more as a co-investor and more as a LP than direct investment. But again, that's my opinion.
Yeah, my 5 cents are only, we are seeing right now competitors in auctions from Asia, whom I have never seen, also from the US, who we have never seen in Europe on assets. I think Europe is right now totally in the focus for investment, and therefore I think there will be a high interest over the next years from new kids on the block.
Thank you.
Thank you both for very interesting discussions.